there's not enough early stage capital being invested in our entrepreneurs here.
That's so crucial. Hey, just like slower.
It's so much slower.
Right.
And so if a founder, needs to raise money in 3 months, go to the US, and you will have way more chances to meet investors and to get funded in that time. And they're going to benefit the US economy. And we miss out. It's our talent that's migrating south. Venture capital is a terrific vehicle for companies that are on a rapid growth trajectory and that are going to raise multiple rounds of equity financing. When we're evaluating companies, part of it is can they go on that high growth trajectory? Do they have a really big market that they're going after? Does the business model make sense? Does it scale?
Like if I give you money, I don't get to say I just wanted it in this one company.
No.
It goes into the portfolio.
Yeah, it goes into the portfolio.
Obviously, you're running Trillick Ventures now. That's your company. But take me back to like the younger Iain before you started this company. Like, what were you like growing up, and how did you get to where you are today?
Whoa. Okay. So as a kid, I was big into sports. I played. I got into one particular sport that I just fell in love with at a young age. It was squash, and so I started playing squash at age 10.
Okay.
And funny thing is about squash is there's not it's not like a huge sport like hockey where you've got tons of people playing it. And so I was really good, really young, and I got to travel, and so that really opened my eyes, and I fell in love with it from the sport perspective, but also because of the travel perspective. And so I did a lot of traveling with that sport as a kid. I played other sports as well, like a lot of volleyball, soccer, and I played other racket sports like tennis and badminton too. But I just fell in love with squash because I think primarily because of the travel aspect. Because I got to make friends, in Calgary, in Toronto, in Mexico, in Colombia, and the U.S. Like it was a pretty international sport from a very young age.
Okay.
And so I spent a lot of time doing that, and it just opened so many doors for me, both personally and professionally. Like I learned so much through that sport. Growing up, going to these different clubs as well.
Yeah.
I spent a lot of time in the squash courts, and it's there's a lot of characters in that sport. There's a lot of great business people who play that sport also. So I got to be the fly on the wall, learning from a lot of people who were whether I knew it or not, they were mentors to me.
Okay.
As a kid, and so I got to learn about business kind of as an adolescent in the walls of the squash clubs and that I would go to. So that was pretty cool and pretty unique as a kid. That really helped shape me, I'd say.
Yeah. And you became a professional squash player?
I did, yeah. In my last couple of years of high school, I switch over to the collegiate, and the reason why I did that was because it allowed me to pick my schedule, so I could go to school half time,
right,
and then train a couple times a day and really do a lot of touring.
Oh wow!
So I played on the PSA, the Professional Squash Association tour, for a couple of years, and took a year off between high school and university to play. Always knowing that I'd go to school eventually, but
right,
because you can't really, unless you're like top 10 in the world at that time, you couldn't really make a living playing squash.
Okay.
Unless you're a professional, like a coach.
Right.
But man, it was a good time. Like just traveling around, again, meeting so many people, and because you see a lot of the same folks competing in the tournaments that you go to. But a great way to see the world for that, like one kind of gap year, I'd say.
Yeah. Do you still play a lot of squash?
Not as much now as I'd love to.
Yeah. It's a hard sport, man.
It is tough. Yeah.
Because squash is like, so there's racquetball and squash. Racquetball, the ball bounces a lot more, right?
That's right. Yeah. So
okay.
racquetball, both very similar.
Right.
Racquetball is more of like a North American sport. Like
right.
It's more played in the U.S. and Canada.
Okay.
Whereas squash is more global, and is more growing, I would say. Whereas racquetball isn't as big as it once was, maybe in like the 80s or 90s.
Right.
But yeah, it's a tough sport, and I definitely beat up my body over the years. But I love to play. I still play a fair bit of doubles, a little bit of singles, and I got my kids playing, and my wife plays, and so it's a big part of our family, and like I'd say it's a huge part of my identity as who I've been growing up.
No doubt. That's cool, man. I got to get on the squash courts with you sometime.
We should do that for sure, man.
So tell me, so you took a year off between high school, university, or a couple years, you PSA, professional squash, and then you did end up going to university after that, right?
I did, yeah. I always had the intent. So before I took the year off, I had applied and got accepted to Western. And so I took just deferred it for a year.
Right.
I chose Western because they had a great school. They had a great squash program, actually. They I think now it's like 40 years in a row that they've won the national team championships in Canada.
No way.
But they were the only men's team that would travel down to the U.S. and play all of the schools there. And so we'd go to all these Ivy League schools and play against their teams. And so it was again just an awesome experience to travel and meet people, and one that really shaped me a ton. But Western was always my choice that I was going to go to because of the squash, and then it's a great school as well. And I had friends who were going there also, but I went there for finance and accounting, just with the always in the intent at that time to join my dad's business. I grew up working in his business.
What was it?
It was a playground equipment. So he was a distributor for commercial playground equipment. So what you see in like school and parks, playgrounds.
Very cool.
Yeah, and so I always wanted to get into work with my dad, and I knew I needed a business degree of some sort in order to really succeed there.
Right. Yeah, you can't really go to school for playground equipment, can you?
Well, you can play on a playground.
Right.
Yeah. It's funny. It's spent a lot of time as a tester as a kid, and then as soon as I could swing a shovel and turn a wrench, I was on site working the construction crews as a teenager, which was a lot of fun, and again learned a ton.
Right.
Doing that as a kid.
So what made you go from family business,
Yeah.
doing playground equipment and installations, to doing what you're doing now, which is Trillick Ventures and venture capital?
Yeah, very different, right?
Very different.
Very, very different. And so playground equipment, it was, so we were a distributor. So it was a really great business, and it was a lot of fun doing that part of my life, building that company. I moved to Toronto in 2009 when I graduated university, and it was great because there was a lot of expansion happening in the GTA. All the surrounding municipalities were having a lot of development,
right?
And so there was a lot of business to be had.
I imagine. I went to McMaster in Hamilton, so I know what you're saying. If you drive from Hamilton to Toronto, you don't even know you're leaving one city and going to another, right?
Yeah.
So I could imagine the expansion, what you're saying, that makes sense to me.
So it was really great timing for me to be there and to sell into that market, and I learned a ton. And by about 2016, when we decided to exit the business, it was we kind of hit a ceiling as far as the expansion that we could do, and we were a distributor, right? So we were buying the equipment and then selling into the market. And like every business is tough. Like you're always going to have challenges, and you're always going to work really hard to excel in it. And I felt like it just had a bit of a cap as far as where we could take it. Okay. And I wanted to make sure that I was working really, really hard at something that maybe didn't have the cap. And that's when I started looking at tech as an opportunity, because you're looking at businesses in tech that are valued at multiples of revenue rather than really low multiples of EBITDA. And so that was the interest in technology and interest in that type of business model.
Interesting. That sounds very insightful of you to be able to just pick that up, multiples of revenue instead of multiples of EBITDA. Did you go through it? Did your family company sell, and that's how you got exposed to that type of deal making? Is that kind of where you got that knowledge from? We
were able to sell back to the manufacturer, so sell the distribution rights and our pipeline of business that we created back to the company that we were representing in the territories.
Okay.
So we got to look at the deal structure that way, and at that time, I would say maybe that's more in hindsight that I look through it with that lens, perhaps, but. It's at that time I was looking for something a little bit more that I could sink my teeth into that could perhaps be, larger.
Okay.
Yeah.
Interesting. So a lot of people hear VC, venture capital, and, don't really know what exactly it is. Can you tell us what it is, and then probably equally as important is what it is not?
Yeah. So, It's very glamorized. I'd say venture capital is, and startups in general are very glamorized. It's certainly not for every business. Venture capital is a terrific vehicle for companies that are on a rapid growth trajectory and that are going to raise multiple rounds of equity financing. So what that means, like we talked off camera about Construction Clock, for instance. That's a company that we invested in, and David, you had on your show.
Right.
That's a company that is very much venture scalable, where there's a massive market, small, medium-sized businesses, and it's not going to grow through cash flow. So they can't grow fast enough through cash flow, where that's where you have outside capital come in,
right,
and work is like pouring gasoline on a fire, where you inject a few $1 million that allows them to turn on their sales engine or marketing engine, however they're acquiring their customers, and then they're able to just grow at much more of a rapid pace.
Okay,
and then companies that are venture scalable, you'll typically have multiple rounds where they inject large sums of capital so that they continue on that high growth trajectory.
Okay.
Yeah. So that's how we invest in startups. So that's the type of startups that we look to invest in. And then it's a vehicle for investors also, like private investors, to put their capital in a private investment that is completely uncorrelated with the stock market. So where we get our capital in Trillick Ventures to invest in the startups is through private individuals. And so you've had some of our investors, or they're called limited partners in venture capital on your show, actually.
Right.
So that's where we pool together capital from individuals and from institutions. And then in addition to capital from myself, and we pool that all together, and that makes the fund. And then so from that overall amount, we then allocate to a number of startups. So for the way that we've structured this Trillick Ventures Fund 1 is that we're targeting to raise $15 million, and we're going to invest that into 15 to 20 different startups. And we're focusing on Manitoba startups because I think there's such a gap in the market. There's no one really investing in here, where there's just so many great founders that are locally building companies that there's so much opportunity for investors to do well. Interesting.
So let me see if I just get this straight. So let's say I put $1 million into the S&P 500, right? That's the largest 500 companies traded in the United States.
Yeah.
If I put $10 million into Trillick Ventures, you're going to put that into like the 15 tech companies local to Manitoba, essentially.
Yeah, so we're going to put...
if I give you money, I don't get to say, I just want it in this one company.
No.
It goes into the portfolio.
Yeah, it goes into the portfolio. And that's so venture investing is 90% of startups fail. Right. So it's inherently, there's risk if you do it into one single investment. And that's why investing in a portfolio makes sense. Because even if you look at the S&P, actually, historically, it's driven by the power law as well, where for years past, it's been the tech startups or the large tech companies that have driven the majority of the returns in the S&P 500.
Okay.
In any venture capital portfolio, in any limited partnership portfolio like ours, it's also expected that 3 or 4 of the 15 or 20 companies that we invest in will primarily drive the significant number of the returns as well. And so that's why you want to invest in so many. It's not like picking the single one investment, saying I'm going to invest in this one company and that's going to be the next Facebook or Google. That's just very, very unlikely.
Right.
And so that's why diversifying the risk over a portfolio is the best way to invest in this type of early stage company.
Absolutely.
Yeah.
So as doing the venture capital, then you said, let's say 15 companies that you're invested in currently, give or take, but surely there's a lot more out there that have probably looked for investment from you. So how do you decide who to bring on into your portfolio? What are the things you're looking for? Surely it's more than just like, oh, I like this founder, right? Like the money's got to make sense, but at the same time, there's still a large amount of risk, no matter how good the company looks on paper. So tell me, what are some of the, metrics and things that you look for when you're investing in a company?
Yeah, so we're going to look at like hundreds of companies. So over a couple hundred deals we'll look at, or companies will come to us, ask, seeing if it would be a fit, and we'll only invest in about 15 or 20 of them. So the amount of no's are high, and partly because a lot of the companies aren't venture scalable, because it's just, again, it's not for everybody. It makes way more sense to take on like a micro private equity type partner that takes a more control of your business, or if it's not going to be on that high growth trajectory that's going to require multiple rounds of financing, then it just doesn't make sense as a VC, because it's those farther rounds. That's how we that's how we make money, right?
Yeah.
We need companies to really take off and 100x or 1,000x from when we invest in them. And so when we're evaluating companies, part of it is, can they go on that high growth trajectory? Do they have a really big market that they're going after? Does the business model make sense? Does it scale? So those are really important pieces. The other is, like, we're investing really early. So we're investing in the people too, right? Like, it's an idea is great, but it's not really worth a whole lot more than the piece of paper it's written on.
Right.
It's really the people who are going to be executing on that idea. And so execution, as you know, in your business and in every business, it's everything. You can have great plans, but if you don't actually do the work to execute on them, and day in, day out, you're not going to get anywhere. And so what we're investing in is we're investing in the founders and the early teams that they have as well, knowing that, so the business model has to make sense, the market has to be there, and then that founder needs to have that grit, that determination, also that resourcefulness and ability to attract other great people to work alongside them on the vision that they've set for the company.
Absolutely.
Yeah.
So I would imagine that those types of companies are the types of companies that, if they reached out to multiple investors, they're probably getting interest from a lot of different parties potentially. You also said that, there's hundreds that come to you and you have to say no to a lot of them. Do you find that there's companies out there that you're doing research on that you're actually approaching instead of them approaching you? Like, hey, we would like to invest in your business. Yeah. Like, you're kind of hunting down these types of unicorn companies as well.
Yeah, ones that we hear about for sure.
Yeah.
Now, because our focus is Manitoba,
right.
I'm in a bit of a unique spot at the moment where we're the only VC in town. So
not much is getting past you, hey?
Yeah, so we kind of have first right of refusal of
right.
every opportunity that's here, which is a really unique and special position to be in. We won't be in it forever. There's going to be, knowing the quality of founders that are here in the marketplace and the quality of companies that are being built here, we're going to have other VCs pop up and set up shop here also. And I hope that happens, because that means that the ecosystem is really driving forward. But for this point in time, it's really unique where we kind of have first look at every deal, and that's why there's just so much great opportunity right now as an investor.
And are you the one, say you're looking at a deal, is it you that gives the approval? Do you take it to the investors, or like, how does that work?
So the way that it works, that's a great question. So we have,
obviously they trust you if they're giving you their money, first of all. So I'd imagine you have a lot of autonomy that way.
So it's a limited partner and general partner. So any investor that we bring into the fund, they're technically a limited partner, so they don't have say in our investment decisions. They're really at arm's length, and that's why they have no liability in what we do. But I do have an investment committee, which isn't always common in smaller funds. Sometimes it's just the general partner, that founder of the fund, that makes the outright decision. But I'm a big believer in surrounding yourself with great people to expand your own knowledge. And I certainly don't know everything, and I know a lot of things that I don't know, and I wanted to make sure that I brought wonderful people who had complementary skill sets to me to my investment committee that can help me make those decisions and also help me think critically. So I've got three folks who are on my investment committee. We've got a gentleman named Saf Hashmi. So he's been a VC for 9 years, worked at BDC Capital in early stage investing. So he brings a ton of due diligence experience and brings a ton of just great value to our investment committee. And then we have two founders on our investment committee, actually. So Mark Hlady, who he is he was a little bit of his backstory. He worked at McKinsey and then worked at Facebook and then founded his own company, which he sold to Roblox. And now he's founded a new company, but he's just a really great product expert. And so really great at technology products, like understanding what's good about it. And so that's incredibly helpful when it comes to the evaluation of the companies that we're looking to invest in. And then we have Noah Polanski, the CEO of Tave, who is someone you should have on your show, actually, because he's local here and he's building a phenomenal company, him and his partners. But he went through Y Combinator with Tave, and they're going to be building one of hopefully the many unicorns that come out of Winnipeg over the next number of years. So having those three perspectives along with my own in the discussion about the deals that we want to do is super helpful, because we're always debating, and we provide just different points of view on a founder or on the company or on the space in general. And so it's really healthy, and it helps us come to really clear decisions on who we want to invest in. Yeah,
that's a really good point. Maybe one of them or you can point out something where maybe the other person had their blinders on too, right?
For sure, right? Because sometimes like we all get close to deals or to founders, and so having different perspectives is hugely valuable. So I really wanted to make sure that we were set up that way from the get-go, just so that we could, just so it helps it just helps for better decision making.
Cool. Now, you've said that launching Trillick required a lot of education. What would you say was the most misunderstood thing about VC in Manitoba when you started?
I think it was the portfolio, having a number of startups in your portfolio. So a lot of people previously in Manitoba who had invested in startups maybe had made 2 or 3 investments into early stage companies.
Okay.
And that's my allocation. I've got a few of these startups, and that's all you need. But in order to succeed in venture, because the failure rate of startups are so high, you need to have a larger portfolio. You need to have 20 or so in the stable in order to see success. And I'd say that was a really big piece of education that was required. And to be fair, I'd say 10, 15 years ago, we didn't have enough good quality companies to invest in. We hadn't had the foundation built here in Manitoba yet.
Right.
And now we do. We've had companies like Bold, Skip the Dishes, Neo. They're starting to spin out some really great founders that are starting different companies in different spaces. And so you've got these rumblings now of this fantastic startup ecosystem where you've got a lot of these new founders that have come from these existing scale-ups, and they're really starting to create some interesting companies. And so right now is a really cool time where we have the amount of startups being built here where you can have a big portfolio of investments in this asset class.
So you mentioned like a few years back there probably wasn't enough companies to like have a large investment in, and the portfolio was small. Now you're at 15 to 20. Do you feel like in like 5 years from now that 15 to 20 could grow to 30 to 50 type of thing?
Absolutely. No, way more. So like there's a flywheel that is just about to start here in Manitoba, and it's called in other places the Shopify effect. So when Shopify is a huge behemoth,
for sure,
right? And they've done so well in growing in Ottawa, and what they've done is the early investors coming into Shopify have made a ton of money, right? When it IPO'd, and a lot of the early stage employees also made a ton of money when their shares vested. And what that created was, you hear the PayPal mafia, there's Shopify mafia as well.
Right.
It's like these early employees that have done incredibly well, gone out and then founded a new company, and they've got a little bit of cash in order to get it off the ground. And then there's this new recycled capital from the investors who've made money from that first company, who then become the angel investors or the early fund investors into their next venture. And so that creates a flywheel, a capital flywheel, and also a talent flywheel, where people have already been a part of that scale up and know how to repeat that same that same process. And the capital is there because the investors have made significant multiples on their money, so they're able to reinvest some of that back into the ecosystem in order to do the same thing over again.
Wow.
And we've got the rumblings of that happening here in Manitoba. So we're only going to see that pick up more and more. And like Calgary's a really great example of where that's cooking. So they've had a really great they're a few years ahead of us as far as a startup ecosystem. Saskatchewan is doing a really great job too, but where they're starting to see some of these companies really take off and succeed and return investor capital, but then also create that next generation of really capable founders that are coming out of those companies.
You touched on the geography there. I wanted to ask you about that because Manitoba doesn't always get mentioned in like national startup conversations, right?
No.
So what do you feel like people like outside of this province get wrong about building companies here in Winnipeg?
So I'd say first and foremost, it's the qualities of the founders, right? Like we're very resourceable. I'd say Manitobans, right? Like we're able to stretch dollars far, and we're able to. We're able to do a lot with a little, and I think that's a really underrated quality that you look for in a founder is someone who's scrappy, who's able to really go and get after it with fewer resources. And so historically, founders here who don't really have venture capital to raise from, they're bootstrapping. They've been able to do phenomenal work with very little, and so your dollars can stretch really far. And just the mindset of the founders, I think that are bred into us from growing up in the cold and just in the environment that we have here, it just has created these really capable founders who can do a lot with a little.
Interesting. We've also been seeing on the news a lot that there's tech companies or entrepreneurs in Canada that relocate to the States because of the benefits, as opposed to staying put in Canada and planting their roots here.
Yeah.
Like, what's your perspective on the difference between like the Canadian versus the U.S. model? For specifically, I guess, for tech companies and startups?
Yeah, well, there's a lot of capital in getting to be invested into tech companies in the U.S. compared to Canada.
Right.
Like just Canada moves slower. There's not enough early stage capital being invested in our entrepreneurs here.
That's so crucial. Hey, just like
it's critical.
Slower.
It's so much slower.
Right.
And so if a founder, needs to raise money in 3 months, go to the US and you will have way more chances to meet investors and to get funded in that time. But the challenge is that if they're going to go raise capital down there, they're going to stay down there and they're going to build their business down there, and it's going to be a US business, and they're going to benefit the US economy. And we miss out. It's our talent that's migrating south, which is a huge missed opportunity for us here. And it's not just Canada going south, it's also Manitoba going east and west.
Right.
And that's why it's so critical that we have capital available for founders here in Winnipeg or in Manitoba so that they can build and stay here, because there's so many advantages to building here. Your dollar does get stretched so much farther. Often, customers are in the US, so you've got the dollar arbitrage there as well, so you can make some money off the hedge. And we can't afford to lose our best people, the smartest founders down to benefiting the U.S. economy. And as investors, we talk about sovereignty, data sovereignty all the time. That's such a huge topic now. And it's also like ownership. We want Canadian ownership of these companies. And the only way we do that is if as investors get interested in investing in Canadian companies.
Given your years of experience doing this now and like how many deals you've seen, the amount of companies that, send you pitch decks or talk to you about this, what would you say is like one red flag you've learned to just like trust your gut on, even if the numbers look good?
Good question. I would say founders that are like looking for a very quick exit. That normally doesn't align with building something that's enduring or going to be very valuable.
Good point.
Yeah.
Interesting. Can you tell us about like a difficult conversation you've had with a founder potentially? Like maybe it's somebody that you had to say no to investing in, or somebody that you have invested in and, because you've got money in the game, now you've got skin in the game, you've had to have tough conversations with them?
For sure, yeah. Having tough conversations is a huge part of this job, and like in everything, the hard conversations are so important, right? It's even personal. Like having the hard conversations are with friends and with family members are critical because it aligns you rather than holding resentment or creating any animosity. And alignment is critical with a founder and an investor. So when it's looking at companies that we don't invest in, I would say it's really hard to say no, or people take it very personally, especially here, I would say, because there's not 100 VCs in Manitoba that are looking at founders. So it's, we're going to say no way more than we're going to say yes. And that can often be looked at really negatively. Like the founder can take that very personally or negatively.
Sure.
And it doesn't mean that it's not, that they can build a great business, or that we don't, it's just not necessarily the right fit for the fund, or right fit for exactly what we're looking to achieve for our investors.
Yeah.
Right. Because I have investors that I have to answer to, and make sure that I'm making the right decision, or our investment committee collectively are making the right decisions for their financial interest.
Absolutely.
So saying no and giving constructive feedback is part of the gig, and it can be met with challenge sometimes, but it's really important, because again, even if it's not the right fit for us, doesn't mean it might be like people need to understand, if they're raising venture capital, you got to get comfortable hearing the word no.
Yeah.
And you can have 100 no's before you get the right yes, and that yes could potentially unlock, that first round of capital that can set you off, and you can do a lot with it. So you have to be resilient. You have to be very persistent as a founder, and no is just a part of the job, like any sales job, right?
For sure.
Yeah,
absolutely. So you had an event about a week or two ago with David Peters from Construction Clock, and then also another investor, where you openly talked about like a deal that you made. Can you walk us through, like, whether it's Construction Clock or another investment you've made, just kind of like walk us through a deal, like in terms of like, why did you decide to invest in them, what type of capital they required, and just how it all came to be?
Yeah, so that one that we did last Tuesday, was for Construction Clock for David's company. The other gentleman that came in was Victor Gutwin. He founded and is the general partner of M25 Ventures out of Chicago, and they're really interesting because they have a very similar thesis to what we do at Trillick. So they invest in only Midwestern companies because they're in smaller geographies where they're often overlooked by the major VCs that play on the coasts.
Interesting.
Yeah. But they're phenomenal. They're able to do so well in these small ecosystems because there's not a lot of capital flowing there. But again, it's the same sort of qualities that you see in these founders and early teams, is that they're super efficient with their capital, and they're really great at building companies with great fundamentals. And so Winnipeg fits right in with those Midwest 12 states that he invests in. So it was great having Victor up. We had him up for a board meeting, and so we wanted to make an event out of it so that we could help share a little bit of information with founders as far as what VC looks like, because aside from founders hearing me talk at the local events, it's nice for them to get perspective from a large VC out of the US who's on his fourth fund, he's invested in over 160 companies, so so really seasoned in that way. And talking about the deal with Construction Clock, Victor was the first VC. He led Construction Clock's pre-seed round. So the way that it worked, David raised some money through angel investors, so like friends and family, first of all, and then from just people close to him, and then the network kind of expanded out, and that's how he got the first tranche of capital in order to grow the business and build his team. And then once he really started to see something that was starting to really work, that's when you normally go and start raising money from a VC, and he was able to bring in Victor's firm, M25, to lead that round. We weren't even in existence yet. So I invested personally in Construction Clock, actually, because we didn't have the fund set up. Otherwise, we would have been in on that pre-seed round as a fund. Right. But we closed our fund, our first close of the fund, 2 months after he did his pre-seed round. And so Victor and his firm led that. And then they are now at another inflection point where they're growing very, very quickly, month over month, and another injection of cash can just help them really grow even faster. And so that's why that next round happened, which it goes from pre-seed to seed, and then it'll be Series A, Series B, Series C, et cetera. And then eventually, normally the exits in startups would be an acquisition from some strategic partner that's bigger than you, or an IPO where you go public. So Victor came in and reinvested his firm reinvested in this seed round, and then Trillick came in and was a sizable investor in Construction Clock's latest round.
Yeah,
which was great alignment. I've got to know Dave now for the last 18 months, and it's just been really great seeing the type of people that he's been able to attract around him. His team is world class, and it comes with, and that's a huge red or a huge green flag with the founder, is that if they're able to attract the best of the best, and he's been able to attract phenomenal people from all across the city. And
David is a talent lightning rod.
Oh yeah.
Right?
Like they're just attracted to his vision, and as a founder, that's like one of the best qualities to have. It's to instill confidence in the people who are coming to work with you, and it's a bloody hard job building a startup, right? Like it's long hours, it's a lot of unpredictability, and so you got to be bought in and jump with 2 feet, and so to have really capable, smart people come in and do that with you, it's a huge sign of where it's headed.
Yeah, absolutely. Yeah, the likability factor for David and his company there, it's just extremely high.
Yeah.
It's funny, like I had grabbed coffee with him every once in a while, and he texted me a few weeks ago asking to grab a coffee.
Yeah.
And so I thought we'd just like meet in the lobby or Starbucks or something, and he texts me, he's like, "Hey, I'm outside, come out to my vehicle." So I go to his vehicle, and we do like 3 laps around like the downtown area, then chatting, and then he just drops me off and he's on to the next meeting. He's always on the go type of guy.
Always on the go, right?
Yeah, but that's like the same with like a lot of founders. I just thought that was like a really funny, way to talk business. But
it's a great way to do it, right?
Yeah, just kind of moving,
Yeah, because we all got lots on the go, so
Exactly.
it's a great way to to fit in important conversations.
So, like when you're investing in companies, and I got a question, like Shark Tank, you see an episode of Shark Tank, and the company does like, let's say $1 million this year in revenue.
Yeah.
So the sharks value that company at $1 million. We'll give you $100,000 for 10% type of thing. But you're investing in companies that have like high growth, high scalability, and surely they're going to be worth a lot more than they are today, right? So how do you kind of like formulate how much you're going to invest for what equity percentage when there's like so many variables? Yeah,
it's a great question, and it normally doesn't, when it's really early stage, it normally doesn't come down to the finances of the business yet. It more comes down to the dynamics of the fund. So when you're investing as a fund, like we're investing in 20 different companies, we have to have similar outcomes projected for all of those 20 companies. So we look at where you're at right now, where we expect you to go, how many financings are going to be required in order to get you there. We're again thinking forward here, but every financing round there's dilution, so we have to account for that dilution of our equity, of our percentage of ownership. And we want to make sure that the companies are all sort of on par with each other as far as the outcome potential, because you don't want. I kind of relate this to poker. I used to play a lot of online poker and in-person poker.
A poker analogy,
right? And so I used to play a lot of these $20 sit and goes, right? And so you'd win a bunch of these $20 sit and goes, and then you'd go play $100, and then I'd lose, and then be like, oh, okay, well, shit. Now I just played 5 games and I won them, and then I lost all that money in one. Right. And so you got 6 games, you win 5, you lose 1, and you net 0. Like that's not ideal. So when you're looking at investing across for a portfolio of companies, you want to make sure that the outcomes can all kind of align. And so the entry prices have to make sense based on what you project the outcome to be.
Okay.
And so one thing that founders often get wrong when they look at valuing their business right out of the gate is it has more to do with the portfolio construction of the fund than it does with necessarily where they're at as far as their journey.
Right.
Yeah. So that's why the earlier the better is often the case for when you start those conversations.
Is there like a minimum percentage of equity that a fund would even consider?
So targets normally for any fund is normally around like 5 to 10% of what you want to take. Like normally every round is as a founder, you'd expect to give up between 10 and 20% ownership of your company. And then it just comes down to the fund as far as what they are comfortable with, as far as how much of that round are they comfortable with taking. So for us, we're always going to be somewhere between a third and a half of like, let's say a company's wanting to raise $1 million, we'd probably come in for like somewhere between $250,000 and $500,000 of that round, and then we would recruit capital from either our other VCs from outside the province or from the States to then co-invest in, or other individuals to co-invest in that round with us.
So with that said, then that guy that you had up from Chicago.
Yeah,
you've probably done multiple deals together.
Not yet. We're going to be, though.
Or will be.
Yeah, we're hoping to. We're hoping to collaborate on a number of deals. Because that's the really nice thing that I like about VC is it's very collaborative between firms, whereas in private equity, which is, you have firms that are like competing, like I either buy 30% of this company or you buy 30% of this company, and we're at odds with each other when you're bidding on a deal. Whereas in VC, it's like we all want to spread the risk. We all want to be able to also spread our ability to help. Like every VC has different things that they can help a startup with. So some will be with hiring, some will be with fundraising, some will be with operations or with product specific. And so every VC will have their own sort of niche that they can help with.
Very cool. Collaboration over competition.
Yeah.
Yeah. For someone that's like early on in their career thinking like, VC sounds really interesting, what's the part of the job that no one talks about that's actually a lot harder than it seems?
The due diligence. I'd say the period of like going through the details of the market analysis, digging into the really projections of where you think each company has the possibility to get to, because for every deal that you do, there's dozens that you don't do, and so there's a lot of time invested in like just work that ends up like technically going nowhere because you don't move forward with the deal.
What's the one like common denominator in due diligence that stops deals most of the time? There's got to be one thing that like stands out the most.
I'd say so. The fastest one to get to is the scalability. So is it going to get big enough to be attractive for venture? And this is again why so many companies are just not venture scalable. You can build a phenomenal business, and you should own 100% of it if you can. The only reason to take venture cap, like people look at fundraising rounds as a huge feather in their cap, but really it's a means to an end. It's not like, oh, I just raised $5 million. Like this is what I need to be celebrating. It's like, no, what are you going to do with that $5 million? That's going to convert to $100 million in revenue or $50 million in revenue. That's what you should be celebrating. It's the revenue, not the cash that you bring in. Because really, in exchange for the cash, you're giving up ownership.
Yeah.
So I would say the biggest quick thing to say no to when you're looking at a potential company to invest in is are they going to be venture scalable truly?
Right. Now, if like you mentioned there, like a founder, maybe of a smaller company, they bootstrap, but they want 100%.
Yeah.
But then you've got a company like Construction Clock or something else that skip the dishes. They want to grow really fast. So they're taking outside investment. They want to grow aggressively. When you take a check from a VC or an outside investor, does that essentially mean you have to sell your company down the road, whether it's 2 years, 5 years, 10 years?
Yeah.
Like you're basically going to exit.
That's right.
business.
Yeah. So we need an outcome.
Yeah.
So bringing in a VC means that we're looking to provide liquidity to our investors, right? So in order to have a successful fund, we have to give multiples of cash back to each individual limited partner that invests. And the only way that they get that cash back is if they have a large distribution windfall. And that comes from an exit. So whether the company goes public or it gets acquired, it's not from a dividend that comes month over month. That's not what we're interested in. And that's why, to double back on what's venture scalable and what's not, you can there's so many phenomenal businesses that pay dividends and have great cash flow. But if they're not growing to where they can get acquired, and typically acquisitions, you're wanting multiples of revenue, you're not. It just doesn't mean it's not a great business. It's just not a fit for venture capital.
Have you ever identified a company that like hasn't tried to grow aggressively, where you've approached them and said, I think your business could?
I haven't done that, but exactly. But they're part of my job as a VC is to get companies to grow aggressively, right? Like we have some in our portfolio who are that are. I love it that they're conservative because they're great stewards of capital, and capital's safe, but and it's a little bit of a dance of like what is the responsible pace to grow at, and that's just an important conversation to continue to revisit. It's like what's the appropriate amount of capital to be deploying for the pace that you want to take it to, and so in prospective companies as well, not even just portfolio companies, but for companies that we're talking to at the moment, actually, it's what's the right spend? So what's the right amount of money to raise? Because what's the right growth rate that you're wanting to hit in order to then raise that next round of capital?
Yeah. Yeah, it's a really interesting space to plan. Like from a person that sits in my shoes for a second, I just want to give you my perspective.
Yeah.
Like I run a business where we flip profitable within the first year. Obviously we're not doing $100 million exit or doing that type of money, but it's just like very forecastable cash month over month, profitability, good margins, whatnot, right? But then you look at these startup companies where it's like, hey, we're burning $100K a month, $200K a month, whatever it might be. We're not going to be profitable for 4 or 5 years, but then we could look at a 10x type of exit or something like that. It's a bit of like it's a totally different mindset. It's a total mind fuck in my opinion.
Yeah, it is.
But I respect
backwards.
it.
Yeah, well, and it's growth, right? Like it's often land grabs in a lot of ways.
Right.
A lot of tech companies are trying to dominate a space, so trying to take as much of the users as they possibly can, as quickly as they possibly can before a competitor comes in and grabs it. So some industries they're winner take all, and some industries you can have a few big fish playing in it. But again, it can be land grabs. So the cash is used as the fuel to then go and acquire customers faster and faster and faster, and that's really where you're trying to acquire users really quickly. Those are venture businesses.
That's why Kevin O'Leary always asks, "What's your customer acquisition cost?" Like this is the first question right out of the gate. Yeah,
it's huge, and knowing what that is then helps you work backwards, right?
Right,
and forwards as far as how much money you need to inject in order to reach your usage targets.
Absolutely. So speaking of looking backwards and forwards, careers under construction, like we're about paths, pivots, progress in this podcast. Did your career feel intentional looking forward, or does it only make sense now that you're looking backward on it?
I would say so a little bit of both. Obviously, everything looks like everything. It's aligned very well in hindsight, and it's really interesting to see how it all come together. I had a startup myself. So after the playground business, I got involved in a startup and founded it with a partner of mine, and we grew it, and it was it was a great journey, and it was one that we failed to raise venture capital with, and there's a few reasons why that didn't go the right way, but in that period, I knew that I needed to learn more about this industry. I came from a very traditional sales and construction business, right, in playgrounds, and I didn't know anything about tech startups per se. So I knew I needed to learn a lot. And what was really cool was I applied to an accelerator, and they had the curriculum there of what to teach you as far as how to go about building your startup. And they were looking for coaches at the time. And so I thought, well, and they asked me because we had an exit. They're like, well, would you be a coach? And I thought, well, okay, great. This is an opportunity for me to get paid to go through this accelerator instead. And if I can, learn the information really, really well and then help apply it to other companies, I'll just learn that much more, and I can apply it to our company. Okay. And I found in that time that I care way more about helping others than I do care about like applying it to myself. Like I got so much more energy from seeing the other founders succeed and working with them. And so looking at where I'm at now, as far as like investing in companies and building relationships with founders and having them and helping them build their businesses, it really makes a lot of sense. That I discovered that about myself going through that process.
Mm-hmm.
Yeah. So I definitely was intentional as far as bringing, as far as entering into this space. This is what I knew I wanted to do. I knew I wanted to get into venture capital for probably the last 5 or 6 years. However, the way it all comes together, it's really fascinating to look backwards on.
You mentioned earlier that you had a Tony Robbins experience.
I did, yeah.
I want to hear about that. Tell me about that and like kind of how it shaped your ideas and how it stuck with you afterwards.
Well, so this was another example of like coaching another founder. So a friend of mine had a business, and he branched out on his own. He was working for a very large developer, and he wanted to get out on his own. And so I was an entrepreneur, and I helped him get his start, and kind of gave him some pointers and gave him some advice. And as a thank you, he gave me a ticket to a Tony Robbins event in New York. And that was
an in-person one.
Yeah, an in-person one. This was back.
That's a cool thank you.
Yeah, a number of years ago, when it was always in person. Yeah. And so that was a really kind gift that he gave, and I went, and it was really eye-opening about intentionality, like living with intention, designing your life, and that's why looking backwards, it's interesting to see how everything has kind of fallen into place to lead me to what I'm doing today. But I definitely took a lot of great nuggets out of that, and going on, always looking to better myself and improve myself and go on that journey, I would say was super impactful as far as where I've gotten to. One quote that I really love is, we always overestimate what we can do in a year, but underestimate what we can do in a decade. And that was one that I got from that weekend. And it's interesting when you look at your career and your life as far as in chapters or in decades,
right.
Decade chapters. And when you start to zoom out a little bit and try and think more in the spans of a decade rather than just trying to chunk everything into one individual year, you can really do a lot of planning, even if something takes a long time to grow. Like this fund has taken a while to get
sure.
to get really the momentum that we now have. When you think in longer time horizons, it just gives you that ability to delay gratification and to pursue something larger.
For sure. Like VC is a long game. There's delayed feedback, requires a lot of patience. Sometimes outcomes could take years, like you said, decades.
Yeah.
But for founders like building in smaller markets like Winnipeg, what's one thing that you wish they truly understood about actually playing the long game? Like you had mentioned earlier, a lot of people just want that quick exit.
Mm-hmm.
But people should really want to be in it for the long game, because that's how you build something great.
For sure. When it comes to companies and also relationships, right? Like relationships with your team, relationships with your investors. Victor said this at our talk last Tuesday, which was an interesting stat. I think it applies to the U.S., but he said VC relationships are longer than the average marriage in the U.S.
Wow.
So the investors that you have coming and backing you in your business, those are going to be long-term relationships, 10 years plus often. And so it's really important that you're cautious about who you get involved with, and make sure that you're building great rapport, and that you're aligned as far as values go, and the trajectory of where you want to take the business.
Interesting.
And so it's, yeah.
So I guess like those relationships are probably so long because maybe you're meeting with people before they're ready for money.
For sure.
Or
exactly.
Maybe they're exiting and they're going to start another company. It's like, oh, we'll be a VC again for their next company that they're going to found.
Or
Is that right?
or some of the employees of a company, right? Like
Right.
there's employees who are phenomenal at some of the companies we've backed already, and knowing that when the company that they're currently involved in has that big exit, they're gonna start something new themselves. And so here we'll have had that like 4 or 5 years of a relationship as they've been part of that leadership team. Well, great. That's a wonderful way to build trust and to really get to know each other. And then when they're out looking for their next thing that they're going to build, well, it's a really natural progression to be the investor to back them then.
Interesting. I never really thought about it from that perspective. That's a good point. What's harder for you, finding companies to invest in, or finding people to invest their money in the fund?
I'd say invest money in the fund at right now. There's so many great founders who are building here.
Yeah.
And the only reason why it's hard getting money into the fund is because of the education piece, is because people don't really contemplate VC as a vehicle, or a limited partnership as a vehicle to invest their capital. Most people, just think about going into the public markets and that's it.
Yeah.
But private investments to outperform these public markets significantly.
They do.
There is a tie-up as far as they're an illiquid investment, but they're completely uncorrelated with the public markets, which is again a really significant, really significant advantage. Especially in turbulent times, like there's a lot of uncertainty in the world in public markets, and so having the uncorrelated investment in VC is phenomenal, a phenomenal allocation to have, even if it's a small percentage of your overall portfolio. So I'd say finding investors who anyone who we talk to who are interested in, like, we're building up Manitoba's startup economy, which is we're helping to do that, and so that's a really easy thing for people to get behind. But it's just, I think it's a new vehicle that a lot of people don't understand, and so that's why there's a lot of education there required.
Yeah, and I can tell by the way you're talking, you still feel like it's in like the early days. Like even though we've had success stories of like Skip and Neo and many others that you mentioned, you seem pretty optimistic that like this is the early days, and fast forward 10 years from now, there's going to be way more of those types of companies.
I'll give you an example. Like Newfoundland is a great example, actually. So there's a VC in Newfoundland called Polaris VC, and they're fundraising their third fund right now. And so they've invested $30 million of venture capital into the startup economy. That $30 million has translated into $1.59 billion in value creation.
Wow.
Which is insane. That's like a 50-something X in value creation for that provincial economy, and that's the type of magnitude of impact that you can have, and that's what we're going to be building here in Manitoba as well. So for the amount of money that is invested, that's the type of impact that you can have locally in the economy. And so it's early days here. In 2024, there was only $2 million of venture capital invested into companies locally in Manitoba, which was the lowest province in all of Canada, which was criminal. I think it was $7.9 billion of venture capital invested in the nation, and we received $2 million.
$2 million.
Yeah.
Wow, that's
so
shocking.
we've got nowhere to go but up.
So you mentioned like a second and a third fund. I'm curious, like, how do you start a second one? Like, when does the first one end and the second one begin? Like, where's the definition there, the line?
Yeah, so it's after all of your initial investments are made. So we will invest, the target for this fund is to invest in 15 to 20 investments.
Right.
And we will reserve some capital for follow-on. So for instance, when a handful of those companies are really, the ones that are really outperforming, we'll reinvest in that next round. So we've got some capital for that. But once those first investments are made, those first 15 to 20 investments are made, that's when we raise the next fund, so that we can continue to continue the cycle of
for
investing
other companies.
For other companies,
right? That makes sense.
That maybe get founded a couple months later than that. But we want to make sure that we've got more capital to invest once we've hit our first initial investments.
Okay.
Yeah.
And what's the percentage that you typically like reserve to reinvest in the high growth first companies?
It varies per fund. Some do none. Some do all the way up to 50.
Okay.
We're targeting somewhere between 30 and 40%.
Cool.
Yeah.
Interesting.
So that way we can really, because it's a huge vote of confidence if you can reinvest in the ones, and so you're holding your equity position or sometimes increasing it.
Right.
That can really help attract additional capital from other sources.
Amazing. If you could sit down with your younger self before launching Trillick, what would you tell Iain to worry less about?
Worry less than many things.
List them all.
I think everyone has imposter syndrome, everyone has uncertainty about if things are going to work out or how long things are going to take to work out. I love the quote, like the bigger the runway, the bigger or the longer the runway, the bigger the plane. So the more time you give yourself to do something, the bigger of whatever it is that you're building, you can accomplish something much bigger if you give yourself more time. This is my first fund. I haven't been a fund manager before. So there's, like in everything, there's imposter syndrome, and you feel like you're inadequate in order to do it. And that's why it's important to surround yourself with people who have that background and have capabilities that you may not have, the experience or the expertise in. And that's why I built that investment committee, bringing people in who had the experience in areas where I lack, because I certainly don't know it all, but it's as long as you don't know what you don't know and you can fill those gaps, that's really critical. So if I were to tell myself, I think it'd be take it easier on yourself. Yeah, because we all beat each other up. It was actually really fascinating. So a good friend of mine, he was a world champion squash player, and we got on the phone for a call. He was interviewing a lot of folks who were high performing in their professions, and did a lot of athletes and investors and just business people. And he said when we got talking, he was saying one of the common things across everybody that he was interviewing was that they all had some level of imposter syndrome. And this is so true for founders too, because they're building something new, right? And so when you're doing something new that you've never done before, of course it's hard to believe that that you're gonna do it, but you have to take that leap, and I think it's a prerequisite to success. And so that's what I would suggest for founders. It's like, yeah, you're all going to have, we all in some way share that, that it's scary. The unknown is scary, but be easier on yourself, because if you put in the work, like you said, podcast number 1 is so different than it's going to be than podcast 1,000. If you put in the work, it's impossible to be bad 1,000
Absolutely.
reps in. So the only way to remove that imposter syndrome as a founder or in anything that you're doing is to put in the hard work. And by doing that, you build certainty. And with certainty, that's how you get to where you're targeted.
For sure. Totally agree, man. The repetitions build confidence, right?
Absolutely, yeah.
Like we said, no one's good on rep 1, but no one's bad by rep 10,000.
Yeah,
Right?
Absolutely.
Last question I have for you, man.
Yeah.
When people look back, when you specifically look back on Trillick Ventures, let's say years from now, 10 years from now, what do you hope it stands for beside like the obvious financial returns? Like what else do you hope that it stands for?
I hope it's a real catalyst for startups in Manitoba. That's what we're aiming for. Is we're aiming for Manitoba to be a place where you can build a really successful startup, and not only have the team that you can hire around you, but the capital willing to invest in you and take a chance in you, so that you can build it here without having to leave to go build it in a more capital friendly environment. I think if Trillick can be known as that fund that kind of took that shot and pioneered investing in our homegrown talent, that would be huge. I would love that. And if we can recruit more funds to come here, seeing the results and the impact that the portfolio companies that we have been able to create on the provincial economy, I think that's the huge impact that we're shooting for.
Yeah. Amazing, man. It's a big impact on me today too, here personally, because I didn't know much about this coming into this, and I'm sure a lot of our listeners don't.
Almost forgot we were on a podcast for a second. It felt like you're so
it's
good
just
at
you
this.
and me
It felt
here.
like just us here.
But when I think of investment, I think of the stock market, S&P 500 traditionally is where I've invested some money, real estate, some rental properties, VC investment into the local economy of the high potential companies is never something I ever even crossed my mind. So to be able to sit down with you and hear about this, it's really refreshing, and I'm optimistic. I'm stoked about it now too. So I hope the listeners, that didn't know about this, hopefully reach out to you now too.
They would love that. Yeah, it's it's a great way to invest in your own backyard. It's really cool to own stuff that other people don't own too. You
Right.
know, just as like conversation starters, it's fun. Like some companies in our portfolio. I was going to just mention one that's not public yet, so I can't say that yet.
Okay.
But
We would have had that at
I'll
that.
keep
We
it-
don't yet. Yeah.
But no, we like the companies that are in our portfolio. We've got some really cool companies that are doing business here in the province and internationally, and so it's really really cool to own a piece of that. And it's not easy to invest in this asset class. And so no, I appreciate you having me on and letting me share a little bit more about it, because it's a hard thing to understand unless you have a session like this where we can really dive in. So I appreciate
For sure.
it, man.
I've always heard that saying, shop local.
Yeah.
But now it's almost like invest local.
Yeah, totally.
Right?
Totally. I love that.
Awesome, man. Well, hey, thanks for coming on Careers Under Construction today.
pleasure.
Really appreciate it. Another episode. Peace.